This policy exchange event on the aftermath of the budget, and sorry for the slightly late start. So we're going to kick straight off, and we're going to go first to hear from Richard Hughes, who's chair of the Office of Budget Responsibility, for your response to last week's budget.
Sure, and maybe the best thing for me to do is just to lay out briefly how economic fiscal outlook looked as the backdrop to the budget and how it had changed in particular since the last one we did in November. And broadly speaking, on the economic side, in the near term, what we saw was, compared with the forecast we did in November and Jeremy Hunt's first fiscal event, the autumn statement, an improvement in the near term on some of the factors that have been weighing on the demand side of the economy. In particular, energy prices, inflation and interest rates had all come down a bit since November. That alleviated some of the squeeze on household finances as well as businesses' finances, and means that in the near term we expect a shorter and shallower economic downturn than we'd forecast back in November, with output falling peak to trough by just 0.5% compared to the 2% fall we expected back in November, when those factors were squeezing households by more. But it's still a big fall in living standards by historical terms, falling by 6% this financial year and next, compared to a 7% squeeze we thought was going to happen back in November. But still better news for demand, and better news for the near-term outlook. But as you look out over the medium term, and we do a 5-year forecast, and you get to the sort of middle of the decade and toward the deadline for when the Chancellor's fiscal rules fall due, you still have a set of structural challenges that the UK economy has been grappling with for a while. Both a loss of workforce that we faced in the wake of the pandemic, chronically low business investment, and also low productivity, which means that in the medium term, our estimate of the UK's long-term growth prospects were broadly unchanged, slightly up on November, partly because of lower energy prices, partly because of some of the impacts of the measures that the Chancellor took in his autumn statement to try and boost employment. But nonetheless, that gave the Chancellor a bit of a near-term fiscal windfall, although not much extra fiscal space in the medium term because of those growth challenges. He got about £25 billion a year worth of kind of extra fiscal room for manoeuvre over the next few years from our forecast, and he spent about 2/3 of that on three broad categories of things: a bit more energy support in the coming financial year, extending the energy price guarantee at £2,500 to protect household incomes from jumping up to £3,000, energy bills from jumping up to £3,000 had he not extended it. A big labour supply package, and one which, through a combination of action on childcare, pensions, and on people on inactive benefits, we think get about 110,000 people back into the workforce, which is a meaningful amount, but only a dent in the 500,000 we think we've lost since the pandemic. And then finally, there was action on trying to encourage more business investment and to counteract the consequences of the rise in the CT rate by allowing what's called full expensing of business investment against tax liabilities, but only for 3 years. And so we do think in our forecast that has a temporary impact on the level of business investment, raises it by around 3% in the 3 years in which those reliefs are available. But then once they expire, you just get the full effect of the 25% corporation tax rate, and then investment drops back to below it where we thought it would be back in November. Because in essence, what this temporary incentive does is just bring forward investment into the 3 years where you get the tax relief, but then you have lower investment in the years afterwards when the relief expires. So some permanent improvements in the employment outlook, some temporary incentives to invest, but not a permanent incentive to do so as a result of the measures introduced. Looking at the fiscal bottom line, where it left, the Chancellor was still meeting his objective in 5 years' time of getting debt to fall as a share of GDP. It's still rising for 4 years, getting close to 100% of GDP in our forecast, and then it falls in the final year by 0.2% of GDP in the last year, which is the narrowest margin any Chancellor's had against his fiscal targets. And when you stack it up against the various risks of the outlook, is a very small amount of money indeed, about £6.5 billion.
Great, thank you. We'll go now to Conor MacDonald, who is our head of economics at Policy Exchange.
Thanks very much, Juliet, and thank you, Richard, for setting the scene. Maybe I'll pick up first on the last point, which the Chancellor was at the Lords Economic Committee today, and he, unfortunately, I think, to your point about the fiscal headroom, was asked precisely this, about the fact that he had left himself so little, and he said, well, these targets are a bit arbitrary anyway, which is, I think, in some ways quite an extraordinary admission. But if I can return maybe to the budget, I think I'd like to focus on three things. Points that Richard just made, but I'll go into a bit more depth. One about the labour market, one about business investment, and one about continuity. I think on the labour market front, I think the government should be commended for the kind of the scale of the package. It's about 7.1 billion, and it involves changes to the welfare system, to how disability claims are assessed, childcare intervention, things on pensions. And what's remarkable about this is that I think it needs to be put in the context of the fact that the UK is the only G7 economy that's seen falls in the participation rates across all age groups, effectively. And to credit the government, they're doing a fire hose approach, partly I think because no one quite knows why this has happened in the UK. There hasn't really been a good explanation, and I think the government should be commended for at least trying to engage across the different levers that they have in this particular space. On business investment, obviously corporation tax is going up this April, which from a tax competitiveness perspective is not ideal. But I think the government, I think, has recognized this, and I think it's partly why, well, obviously it's part of why the government has chosen to take on full expensing, which is in some ways, and how the government has sold it is clearly kind of, they want to try to make it seem like a continuation of the super deduction that existed during the pandemic. Obviously, this will do quite a bit for making investment more competitive. I think the big caveat I have here is that they've chosen to not make it permanent, in the sense that it will expire. The Chancellor says he wants to make it permanent, but under the current fiscal plans, it will expire in 3 years. And I think the open question I have is whether or not the temporary nature of this tax cut will kind of fundamentally undermine its effectiveness, and I think that's still an open question. And the third point on continuity, as much as the government has done a significant amount on the labour market, trying to do something new on investment, I am struck by the amount of policy stability that we're seeing between the last fiscal statement and between the broad approach taken by the Conservative government. So we have the fruition of the Trailblazer deals with the West Midlands and with Greater Manchester that they have implied that they would like to see rolled out quickly to parts of Yorkshire. On childcare, the expansion of the offer is quite significant, but it uses basically the same method and the same kind of mechanisms that previous expansions of childcare have taken. That is an increase in the free hours entitlement. And then finally, on investment zones, on kind of pension reforms, these are sort of, how would I put it, sort of continuations of work that the government has already signaled it wishes to move forward on. And I think to this extent, given how turbulent the last year has been, I had one kind of foreign interlocutor say to me recently that there has been a certain degree of policy fluidity in the United Kingdom recently. I think that it's a good thing that on a number of fronts the government is projecting a degree of policy stability over the next 5 years, and it looks like a set of priorities that have been laid out over the last few months will continue, and I think that can only be a good thing. Maybe I'll leave it there.
Thank you. We'll now hear from Bim Afolami, who is the MP for Hitchin and Harpenden and chair of the Regulatory Reform Group.
Thank you, Juliet. I suppose there are three things that strike me about this budget politically. The first, and I won't go into the detail of this, I think Ruth will do it afterwards, but is the intervention on childcare. This is a significant political ask from the party. Siobhan Bailey, amongst others, has been demanding this. So many of my, particularly younger colleagues in the House, have been demanding that we deal with the rising lack of affordability and lack of availability of childcare for younger working parents. Disclaimer, I have 3 small boys. On this issue, we're really demanding that we deal with it. So I think that is going to have a significant political effect, notwithstanding, obviously, now work on the delivery of that policy intervention, making sure that it really achieves the results that we want. So I think that's the first thing that's hugely significant. The second, and it's been mentioned a couple of times already, is the point around business investment. Now, the super deduction, which for those who are not fully au fait with it, effectively gave a 30% tax credit to you. So you didn't just get taken off your, if you're a business and you made qualifying investments, you didn't just get it deducted from your tax bill. You actually got given money to do this to the tune of 30%. The super deduction raised business investment, I think, Richard, correct me if I'm wrong, by only 6% over the last 3 years, which, to be honest, if you'd asked me before the super deduction, I'd have assumed it would have done more.
We did too, yeah.
And I think you predicted 10.
Yeah.
Well, you see, OBI, you can't trust them. That's a joke. I have huge faith. I have huge faith and respect for the OBI. The point I'm trying to make is it shows how hard it is even when you make significant policy interventions to really change the underlying behaviour of businesses in a complicated free market large economy like our own. So that should leave us with a bit of humility around the full expensing regime and various other interventions to see how much of an impact that really makes to deal with what has been a long-term structural problem of businesses not fully investing. And then the third thing, what else I want to mention? Oh yes, the third point, and I'm not just saying this because I'm chair of the Regulatory Reform Group, but I think that the Patrick Vallance work on regulation in the medical and science arena, though particular to that area and the MHRA and the speed and the style with which they approve drugs, though specific to that area, shows the government's willingness that I hope we will see, and I've already been with the group and working with the government in many different areas and looking at the whole system. I think it shows the government's willingness to actually make meaningful regulatory changes when they see that it can benefit the country, both society and economically. I hope that the Patrick Vallance review is the first act of what will be several acts coming over the next 12 to 18 months of this Parliament, because I think that could have a significant benefit to the regulated part of the economy, which is roughly about 25% of our economy. When you take out the public sector spend of our GDP, you're getting to 45% or so. So it's a significant part of our economy, and I think that work on regulation with my group and others hopefully will continue.
Thanks, Bim. And now we'll hear from our last speaker, Ruth Kelly, who's the former Secretary of State for Transport, among many other roles.
And education.
Thanks, Juliet. Absolute pleasure to be here. Loads to pick up on there, and just let my overall take on the budget is this was very clearly a steady as she goes, reassuring budget. No risks could be taken after the fiasco last autumn, and that meant that the room for manoeuvre was strictly limited. There was some room for discretion, and therefore it was used to the absolute full, as Richard has already said. The OBR was listened to, the fiscal rules are still in place, they're being respected, but within those boundaries, there was a little bit of slack that could give, and that was absolutely fully used. And the good news, from everyone's point of view, it's not just was that the case, but it looks like a technical recession has been avoided. So that's the sort of good news headlines on the budget. Beneath that, there's a much less rosy picture. Taxes are going up. They're going up for so many people because income tax thresholds have not been indexed. That will really hurt people going forward. Living standards 20 years on from the financial crisis would not have risen. This is quite an extraordinary picture of what's happening in the economy today. And given those underlying trends, it's not a bit surprising that the Chancellor and the Prime Minister have tried to focus on raising the productive capacity of the economy. But this is an incredibly difficult thing to do. It takes a very long time, and it's actually not clear what works. So we've just heard, does expensing investment work or not? Actually, maybe it will in the short term. It will possibly all fall away in the longer term when that's removed. So it's a very, very difficult thing to do. So much focus in the budget was about getting people back to work. Again, it's not clear that those levers will be as powerful as they are going to be expected to be, but certainly everything is being tried, whether it's pensions for consultant doctors or benefit changes for people who are out of work through disability, or whether it's trying to get mothers, particularly mothers, I would arguably, of young children back into the labour market through the childcare reforms. The other aspect of the budget was stealing Labour's clothes as much as possible, I think, on the childcare reforms. So, responding to the wishes perhaps of some Conservative backbenchers, but actually even more strongly perhaps the wishes of many Labour backbenchers to invest significantly in childcare. Personally, I think it was the wrong way of trying to stimulate that part of the market. It risks childcare places being lost rather than an expansion of childcare places, with the state setting rates for how much it will fund per hour of free childcare, and nurseries losing the ability to cross-subsidise from younger children through to nursery-age children that they have had before. We'll have to wait and see how that is rolled out in practice and how that works. More fundamentally, it sort of looks at bringing up young children as something, as it were, that keeps women out of the workforce in very instrumental terms, rather than thinking what is the best solution for families and for parents to make between themselves about who looks after children and whether they should be looked after at home or in or whether they should go to formal childcare arrangements. So I think the Conservatives missed a trick, actually, by not giving people choice, but by investing in very sort of stable but regulated childcare systems, and wait to see about whether any additional flexibility is injected into the system as well. And just lastly, the one thing that was completely absent, in my view, was, other than childcare, nothing about public service investment or public service reform. And the Prime Minister in the past, when he was Chancellor, talked a lot, certainly in public and in private, about the need for a big public service reform agenda. Again, it just seems completely absent from the debate.
Thanks. We'll go now to questions. We've both got questions coming from online and hopefully also from in here. So if you want to ask a question, raise your hand and please say who you are and who you represent, if anyone, other than yourself, before you ask your question. We'll go to the back gentleman just there.
Ian Mansfield, Director of Research here at Policy Exchange. I'd like to follow up more on the childcare policy and pick up the fact that the reform is uncertain and may or may not happen. It feels like in this, as in housing, the government has responded to a supply-side crisis by propping up demand, just as Help to Buy is there. We really welcome the views on the panel on whether this will just get us back in the same position in a year or two, and what the long-term economic impact on that is likely to be.
I don't think that's entirely fair. Let me explain why. On the supply side, obviously, one of the difficulties is that there aren't enough nursery places, so we're paying, I think, 30% more per child than we currently do to nurseries, so as to hopefully generate a bit of that. We're also loosening the ratios, I think, from 1 to 4 to 1 to 5 as well. So I do think those things will make a bit of a difference, though I think it's also fair to say that the devil of this will be in the detail and the implementation. I did question time last week in Warrington, and the one thing that came up when we talked about the childcare debate, which, by the way, we could have talked about pretty much all night, was people sort of wanting the policy, but really they need to trust that it's going to work and it's going to deliver within a reasonable time frame. And I think that it's up to us now to get that right. But I think Ruth's point is a really, really interesting one. I think there's some colleagues of mine who feel that we shouldn't just be saying there's only one model for looking after children and the government supporting that model. I think that we should really think about how we build in more flexibility into the system, people who want to stay at home and look after their children, and hope that we can do that as we implement it over the weeks and months ahead.
Can I pick up on that as well? I think it's a really good question, and I suppose to Bim's point about the devil being in the detail, the budget also included a paragraph about a likely consultation at DFE about further loosening of restrictions around what the burden for childminders is in terms of early years foundation, the EYFS, around kind of allowing childminders to operate on different premises, looking at different ways in which the UK currently, relative to many of our peers, regulates more heavily in the childcare sector. And I think it'll be really important for that to go ahead, to ensure that there is enough supply for this expansion in demand. But also on the question about childcare in the context of this budget, I think it's not a surprise that in this budget the government, in my view, has taken the approach it has, because it seems very much that the government has chosen to see it purely through the lens, or overwhelmingly through the lens of responding to a labor supply constraint in the labor market. Now, there are other ways you can tackle the affordability problem in childcare. One of the ways that North America chooses, both Canada and the United States, under Biden with the child tax credit, is to basically give direct subsidies to families. The problem is, from this government's perspective, the evidence on that suggests that when you do that, families will pocket that money and use it to fund one parent's working fewer hours. And from the perspective of a country that has a significant problem with its labor market, that was just not the ideal policy solution to a set of labor market constraints. And I think that's why the government alighted, or that's one of the reasons the government alighted on the solution that it did to the affordability problem. But to be clear, to both Bim and Ruth's point, it is not the only way you can deal with the childcare issue and the affordability issue. From my own, I'm a Canadian. I was doing the calculations recently, and if a median family in this country, if they have two kids under 2, they get about 1,800 pounds in terms of child benefit. The equivalent in Canada is you get about 9,000 pounds over the same year period through the Canada Child Benefit. And I suppose the point there is that
there's a man who wants to move to Canada.
I suppose what I'm getting at there is that there are many ways to skin this cat, and one of the most interesting, from my perspective, developments in childcare policy in the UK over the last 20 years is that often changes to childcare policy have come as a response to certain constraints in the labour market, and that leads to a response that basically prioritises more subsidised places outside the home so that both parents can work.
Just a quick question to Richmond. Does your analysis assume any supply response, or is that a factor in terms of the labour market impact of this policy?
So in terms of supply response, the other dimension is that the policy is also phased in, so I think that also gives some time for there to be some supply response. I mean, when we costed it, there was, as Bim said, an assumption that the cost of providing the additional childcare is going to be 30% more expensive because you lose this ability to cross-subsidise between what is at the moment charging for 1 to 2 year olds and then using that to cross-subsidise the 3 to 4 year old offer. And I think it is being phased in because because that supply is not available now, and you do need to reduce the ratios. Nonetheless, it's still a pretty ambitious timetable for getting a supply response from carers themselves. In terms of the way in which the supply response works more generally, which is a supply of people working more, the employment going up and people working more, one thing to stress is that the benefit that you get in terms of extra hours being worked partly comes from an extra 60,000 young parents joining the workforce because they've now got access to childcare. But another sort of 50% of the benefit is from people who are already currently paying for childcare getting more because a chunk of it is now being paid for by the state. So you also see parents who've already, of 1 to 2 year olds who've already got, or young people who will be 1 to 2 years old at the time, being able to work longer hours because more of that childcare is being subsidised and they're able to purchase more childcare themselves.
Mm-hmm. Okay, we'll go to a question from online. David Hughes from the Business Innovation Group. So are we patching him in? Is that the idea? Yeah. Oh, you're on mute, David. Apparently. And you can ask your question. No. Okay, we've lost him. Does someone else in the room please raise your hands if you would like to ask a question? Yes.
Good afternoon. Alex Simakov, Research Fellow, Policy Exchange, Energy and Environment. My question is about the windfall tax on renewable generations. As folks have pointed out, it's a major inhibitor of investment into our renewable sector. On absolute terms and relative terms, it does put a higher effective taxation on renewables than it does oil and gas investment. Was there a consideration or a thought to either allow a capital allowance or reduce the windfall tax in terms of competing with Europe and America for green investment? Was that a challenge, or was there confidence in moving forward with the current fiscal regime?
Can I build on that and maybe ask you, Richard, how did you factor in kind of significant changes in American industrial policy?
So because they're ongoing, and I think because they're part of the wider sort of trade and investment environment, I would say they're sort of reflected in what is a pretty what has and continues to be a pretty disappointing investment baseline forecast for the UK in the sense that you've seen basically zero growth in investment volume since 2016, and I think that is partly reflecting shocks, it's partly reflecting choices that we've made as a country, and it's also partly reflecting the instability in the tax regime. Where when you ask businesses what do they want in order to get them to start investing again, the word you hear over and over again is certainty. Now, the world has not offered anybody much certainty over the last 5 years, but also the policy regime has not offered them very much certainty in terms of what is going to be their after-tax rate of return. And so you also have to factor in there's been so much tinkering with the corporate tax regime, both with rates and with allowances. And that is one thing that's clearly been inhibiting business investment up until now. And your point about consistency and continuity, I think, is one which would be very welcome if we do manage to get some in the coming years.
Do you think that, on that point about continuity, do you think the super deduction was significantly undermined by the fact it only lasted 2 years?
Probably. And as Bim said, we thought at the beginning, and based on what had been empirical studies of similar interventions in other countries, that we'd get about a 10% boost to investment from it, but it came in at exactly the same time as an energy crisis, which in particular boosted the cost of doing business for a bunch of businesses for which energy was a really important input. And so it was the wrong crisis at the wrong time for this sort of policy. But it may also be the case that these kind of policies have less of an effect than you might expect in the current environment.
Do either of you want to comment specifically
Just-
on renewables?
just
the
on
other taxing
renewables.
something we want more of, the super tax, is that a good idea?
Well, I've never been in favour of super taxes, as you know, Juliet. I mean, I think that, however, this is difficult because the difficulty with us getting more renewables on stream is not a lack of investment. It's constraints around planning. It's constraints with the national grid. They are the biggest on renewables at the moment. There is more than enough capital for deploying, whether it be solar, offshore wind, onshore. And again, onshore wind, just to make the point, the issue is not that people don't want to invest in it, it's that there are political and planning difficulties with delivering that policy. So I think when it comes to renewables, it's the other things that hold it back. And oil and gas, frankly, if you look at the trend for, global trend for the demand and the supply of oil and gas, which regardless of all of our ideological or other desires, we are going to need more of over the next decade in order to make the transition that we need. We're going to need lots of oil and gas. Structurally, the supply demand is coming more out of whack over time. So we need people to invest in oil and gas. So that's, I think, why we've ended up in the position that we have.
Right, we'll go to another online question. Tony Hillier from Arpeggio.
Come on, Tony, don't let us down.
Make sure you unmute yourself.
Yes, can you hear me?
Yes, we can.
Good. I just wondered whether the panel has thought about the question of managerial competence as being the source that either helps or doesn't help productivity. The economists are beginning to talk about management practice, and when the skills debate is brought to the fore, people talk about the skills of the workers, but not of the managers. I'd like to hear a general comment on that.
Richard, how do you factor that in to a qualitative thing to the economic model?
So again, I think it's sort of in the baseline. In that I think it's been an issue which a lot of scholars have of the productivity puzzle have commented on, and as one reason why our performance on productivity has been underwhelming compared to some other countries. I think one thing to be slightly kind to managers of British businesses, one of the things which they contend with compared to managers in some other countries is huge amounts of turnover in their workforce all the time, and so I think they struggle to hang on to talent. They get blamed for not investing in their workforce, but they have to deal with the fact that their workforce is oftentimes with their firm for much shorter periods. So when you think about how much is it economically rational to invest in your workforce, and to what extent are you reaping those benefits versus your competitors when they walk across the road and start working for your competitors, I think that we have one of the flip sides of our very flexible labour market is the fact that there are therefore incentives for managers to underinvest in their staff, and much stronger incentives for individuals to invest in themselves because they're a very mobile resource. But businesses probably underinvest in them for that reason. And I think that's another reason why people say my manager doesn't care about me, my manager doesn't invest in my skills. But that's because the manager's thinking you might not be around in 5 or 10 years.
Yeah, I mean, I think managerial competence is a real issue. And we have in this country a long tail of underperformance on productivity. So our big firms, we've got hugely fantastic, highly productive firms, and then lots more that really aren't performing anything like at the same level. And you've got to start asking yourselves why that is. And there are various factors why that might be. And as Richard said, there's lots of studies looking at this. One might be that we're not spreading best practice effectively enough, for example, but another might well be that we're not investing in our people, or they're not investing in their people enough. And some of it might be the hire and fire culture, if they have it, but it could also be that we just don't seem to invest much in middle management training. And I think that's a real gap in our sort of skills system at the moment. So I agree with the questioner. I think there's a real issue there.
I mean, I agree. There's if anybody here hasn't read, who's interested enough to turn up to something like this, who hasn't read Andy Haldane's speeches, they are fantastic on this very subject. The long tail point that Ruth's just made, I won't repeat it, he explains brilliantly, and I would urge people to read it because he's done a lot of thinking about this. I think it explains a lot. But I'd also say something else, though I will say this very gently, being a politician, is I do think that we are going to have to think about the efficacy of a lot of our state. And that's not just in Whitehall, that's in local government, that's with the mayoralties, and that's not a criticism of any one individual at all. But if you look at the things we're asking our economies to do in the modern world, and the degree of state involvement that we are putting on state, and indeed regulators as well, I think we're going to have to look at how effectively we're using powers, how effectively we're designing our systems, everything from how the civil service operates to how the political parties operate and how we choose people and how we make decisions, down to how we operate at local level as well. That is all part of this management competence, or rather the lack thereof, in our culture that you find also in businesses as well. And I just think as a country we're going to have to think about management much more seriously if we want to achieve what we want to achieve.
Can I
Briefly.
Yes, because this also lets me plug a bit of policy exchange research that we're working on. I think this is, to the Prime Minister's credit, this is clearly a question that he thinks about quite a lot, because when he was Chancellor, the Help to Grow Management scheme was something he championed quite a bit, which is based on the Goldman Sachs 10,000 Businesses initiative. And it's basically a scaled up version of that program. And it's with business schools, and it's basically an intervention through higher education institutions to improve management at small and medium-sized businesses. And by all accounts so far, in the anecdotal evidence I've received in how businesses speaking about it, that it does seem to be, for the first time in a long time, an enterprise intervention that seems to be working and improving the productivity of the firms in question. And I suppose the question I have going forward is, if there is these kinds of interventions that could be made, is there something there about finding? It won't be a silver bullet, but certainly, have we found some kind of formula that uses both the third sector, the state, and businesses themselves to deliver better management outcomes for firms. And the evidence for the program is going to be published next month, and I'm going to be looking at it very closely.
I have a question, so I'm going to pick myself, which is the pension reform in the budget to remove the cap on lifetime savings and increase the annual allowance was framed, as a sort of tax giveaway for the rich. But I wonder, does it have, in your models, or does anyone else think it has any significant impact on savings in the economy, and does that in turn potentially affect investment? Because that aspect of that policy doesn't seem to really have arisen at all.
So the truth is not a huge amount. Partly because we are in the baseline part of our forecast, assuming that there is a significant fall in the savings rate because of the cost of living squeeze. So at least in the near term, we assume people dip into their savings to try and get them through this cost of living crisis to the extent that they have them, to deal with the fact that their earnings are not keeping pace with their expenses, especially because those expenses are coming on what are essentially essentials, not things that you can postpone or avoid. So it's not providing a very big near-term boost to the savings rate. And in the longer run, I think the general sense in this country is it's not the supply of savings which is holding back investment. It is basically the difficulties of finding reliable long-run returns on those investments. In the UK, we have big pension schemes in this country. The issue is that they just don't seem to put their savings at the disposal of businesses to invest. Not so much the savings aren't there.
Yes, in the front here. If you could just wait for the mic to make its way to you.
Okay. Martin McTagg from the Federation of Small Businesses. There was a really big cut in R&D tax credits for small businesses. And I just wonder whether Richard or any of the other panel think that that's had an impact on, one, innovation, and two, investment.
Would you go first?
Conor, why don't you should go first?
So I don't have any hard data, but all the anecdotal evidence I've received is that it seems to be significant drag on small, medium-sized businesses. It was striking that in the budget, I think this time around, they increased the RDEC for larger businesses to 20%, and they had, I believe, measures on if you were a loss-making SME, HMRC would reimburse. So I think that's partial. That's admitting partially that there is an issue here. I would have liked to have seen more, though, given the response of SMEs to the changes to the R&D tax credit.
And I think on our side, it's another area where there's been so much instability in the regime. It's difficult to know quite what has been working because so many different things have been tried in succession. I know there were concerns about the R&D tax credit being sort of exploited by some smaller businesses, and a need to tighten it up and make it clear that it was focused on genuine research, development, and innovation. I think we'll watch what this latest policy regime does, and if it's around for a while, you could probably judge whether it's working. But again, it's hard to judge when you're making so many changes.
Have you anecdotally seen an effect?
Yeah, I mean, just to give you an example, in Australia, where they have an intensity model, what they call an intensive R&D business has a level of investment of 2%. Actually, the government set that intensity level here at 40%, so it largely excludes virtually all SMEs from this scheme, which is, I think, a big mistake.
Yes, we'll go here first. It's the lady in the green.
Hi, thank you. Eleanor Pope, FTI Consulting. I'm just wondering, I think many of the panel have pointed out that this certainly seems to be a budget that is supposed to instill confidence and sort of the steadiness of government policy. But I'm wondering, given the recent sort of events that went on with Silicon Valley Bank and all that we're seeing in the financial market, how the Conservative government are now able to instill confidence in UK markets and whether that's been disrupted. Because, up until the budget what should have been the news covering what's going to be happening. Instead, we were seeing what is happening with the markets instead.
I'm glad we didn't get through this event without a
Yeah.
question about banking. Really
Yeah,
want to
sure.
go and then
I mean, you know, if you go back to the trust regime, the budget actually precipitated a crisis.
Do we have
This time it wasn't the direct cause of the crisis, but they were very much aligned in timing. Look, I think it's a really significant moment in financial history at the moment. I mean, the odds are that we're not going to have another meltdown, but the risk factors are absolutely clearly there. On the plus side, banks are much better capitalised than they were at the time of the last financial crisis. We probably could see a failure or two without widespread systemic effects, but the regulators have been and the governments have been so risk averse that they haven't been prepared to see that happen. So despite all of the reforms that were taken at the time of the last financial crisis, it looks like every single bank that is, you know, on the edge is going to be bailed out, or at least that's what, you know, it's looking like at the moment, or strongly encouraged. You know, another bank is strongly encouraged to take it over, as we've seen in Switzerland, and time will tell whether that was a bailout or not. I think for the general macro situation, it's I think the bank would be extremely brave to continue raising interest rates and selling bonds into this into this environment. I think it would be extremely brave. So that's something that, you know, the government will have to be very, very wary of in future, and it could be that inflation is more persistent as a result.
Yes,
I
mean, I basically completely agree with what Ruth was saying. And the only thing I'd add is that what we have in the United States is a situation whereby the regional banks in the United States are where most of the SME lending occurs. If they have hiccups in their system that are basically, and it's important for people to understand why this is coming about. When you have a long time where you have near zero interest rates, and then we seek to raise them actually quite quickly, considering the stock of debt that's there, you're going to get things going wrong. The tech sector, a lot of stocks look overvalued, a lot of businesses look in trouble. There'll be other sectors that aren't in front of us now that may well appear are going to be in difficult situation. And I think that not only will central banks be brave to continue raising rates, I think that we could get to the position where you end up, which is the position we've all been trying to avoid, which is low growth, because this level of interest rates I do not think is compatible with growing considering the amount of debt weighing on the economy, you know, growing our economy sustainably. So low growth at the same time as interest rates that don't necessarily go up much, but can't go down much because inflation is quite persistent. And that is the absolute nightmare outcome that not just the UK, but all sorts of other developed economies could be facing. And I'm not entirely sure if there's a clever policy intervention. I don't think there's a super deduction for the sort of global economy. You know, there isn't some sort of clever policy intervention that deals with these sort of problems. So, and I just think, you know, I know, and people like Sam Woods, the governor, the chancellor, the prime minister, people who know their other counterparts, they're well respected across the world, and I trust that they'll be working very closely with them to try and alleviate the problems.
Can I just pick up on that? I think just to kind of underline how difficult the situation is, I think it's fair to say that the actions that the British government managed to pull off a pretty remarkable deal on SVB, but the actions of the American government over the last few weeks and of the Swiss government over Credit Suisse are pretty remarkable. I mean, basically Janet Yellen said that SVB was so structurally important or so systemically important that we're going to ensure all depositors can keep their deposits, which, given that it's a regional bank, is an extraordinary state of affairs for the Treasury Secretary to say something like that. And it actually kind of blows apart part of the Treasury's rationale, the FDIC's rationale for insuring deposits, and it raises huge questions about what it means to be a systemically important bank, and why would you be a community bank if you're not going to get that kind of support from the American government. And on the Credit Suisse thing, I mean, it's extraordinary how fast they move. There's a great Financial Times piece today, very, very long, going through what happened. And basically on Friday, the Swiss authorities contacted Credit Suisse and said, you will be merged by UBS by Monday, and you will announce this before the opening of the markets in Asia. I mean, it's extraordinary how fast.
No shareholder votes.
No shareholder votes. They passed emergency legislation over the weekend. I mean, I think there might not be the same degree of systemic risk that was in 2008, but it's extraordinary the extent to which international financial authorities are moving very quickly to make sure that such a systemic risk doesn't arise.
I'll just raise one thing which someone in the finance industry in the US raised to me today on the interest rate point, which was that the Fed's liquidity support for all of the regional banks has effectively undone most of the interest rate tightening they've done already, and on that basis, given that inflation's still around, they thought that the Fed and other banks should continue raising rates. So we'll go to a question here.
Josh Buckland, Senior Fellow at Policy Exchange. Just a bit of a more political one, obviously, and you made this point, Ruth, around the fact that the Conservative Party slightly stolen Labour's clothes on the childcare package. Both parties are obviously quite focused on regional economic growth at the moment. Obviously, the Conservative Party, by definition, are for low taxes, but in reality, the tax burden is going up. So just fast forwarding to the next election, just in your view, what is the differentiator, the economic offer to the country that is different between the Labour and the Conservative Party? Or are we heading into an election where effectively the broad economic offer from both parties is effectively the same?
They're not too different. I think it will be about economic competence ultimately, and there'll be nuances here and there about attracting green industries and how much you're prepared to spend to support them, and creating a national endowment fund, which is one of Labour's flagship policies and so forth. But I think
not for long.
but I think actually the parties are much closer than they have been for a while.
I do think there is a potential area of real difference, right? And it's about whether we can fashion an argument around what the state should do, how it does it, improved regulation, more effectively championing the consumer and competition, nimble, agile, fresh, dynamic, young leader, great, versus sort of a more old-fashioned, more centrist, yes, but ultimately no new ideas, steady she goes type economic offer from Labour. I think the chance for the Conservative Party is to fashion the former, but obviously over the next year we'll have to persuade people like you that we can do that.
But then why in that case was the childcare package almost identical to Labour's and doing exactly the opposite of what you suggest?
Ruth, since you've been in the House, you're in the House of Commons, and now you've graduated to a level of seniority, you no longer have to ask these sort of political questions. You know, we're here to talk about the economy and the budget, and no, in all seriousness, I think that the childcare package is something that, you know, Conservative backbenchers, Labour backbenchers, we're all sort of clamouring for, and I think that, you know, the party has responded to what was the need of a lot of voters.
Before we end, I just realise I did not bring Richard in on the banking question. I now just wonder whether all of this, you know, market turmoil over the last week, what does that do to your forecasts?
Well, I'm very glad we did it last week rather than this week. I think it does underscore two things. One is that the big rise in interest rates that Bim was talking about, which has happened worldwide, is just putting the whole system under stress. And we see it most clearly. I mean, the Bank of England is very much in charge of financial stability in the financial sector. We see it most clearly in the public finances, where a government which has now got a 100% debt to GDP ratio has gone in the space of, you know, just 3 years from spending 3% of its budget, of its revenues on debt interest spending. It's going up to 8% now, which is going to mean that debt interest is the second largest government department, if you think of it that way, after the NHS. And that is just how quickly interest rates have risen and how quickly they work their way through a debt stock, which has got a relatively short maturity nowadays. So we see it as a stress on the public finances, but it's also happening out there in the wider world of in households and in companies. I think the other thing is it just underscores what a volatile environment we're all operating within. We've seen a series of shocks from the pandemic through the energy crisis. now the normalisation of interest rates putting the system under stress once again, chancellors don't get much of a break these days when moving from the kind of last set of challenges onto the next, and that's one of the things which has driven up public spending. It's one of the things which has driven up the level of debt, because you've just got to cope with shock after shock and have to respond quickly.
Great. I'd like to thank all of our speakers and thank you guys for coming along, and whoever was listening online for tuning in. Thank you very much.